Welcome, everybody. If you can hear the sound of my voice, somebody could raise their hand. If nobody can hear the sound of my voice, everybody should raise their hand. I see some hands being raised. Oh, good. Always good to see. I'm putting down the hands. If you wish to ask a question or something like that, raise your hand or type it in the chat. You all should have copies of the handout for those of you that have difficulty downloading it, which some people do. I'm not sure why, but some people do. And pasting it in the chat, a direct link. Why not? All right, let's do it. Let me make sure. All right, all hands down. All right. I promised 5 ways to analyze a property's performance for investment properties. I'm putting down everybody's hand. If you have a question from now on, maybe raise your hand. Otherwise, type it in the chat. Give me a chance to get going a little bit, and then I'll be happy to answer questions. How about that? All right. There's actually more than 5 ways to analyze an investment property. And just as a general, warning, disclaimer, is we really don't want to be giving people financial planning advice because unless you're a certified financial planner, let me say that. So you ought to, as a real estate agent, know some financial planners, you ought to know CPAs. But if you've got somebody who really wants to invest in real estate, well, how would you analyze the properties? Now, generally speaking, there's 2 different kinds of investments. There's the flip and then there's the hold. All right, and the flip typically is residential property only. It doesn't have to be, but typically it is. And the buy and hold could be residential, it could be commercial, it could be industrial, agriculture, it could be a lot of different things. But we're going to spend most of our time, we'll talk about the flip, and we're going to talk about how to analyze a multi-property, like a multifamily, not multi-property, multifamily. How about that? Multifamily, right? And so there's some terms that we need to know. And some of these concepts sort of play off against each other. At the end, I'm going to show you how to use software that you all probably have access to and how to actually put in some numbers. We're going to look at some properties on the MLS and look at exactly how you might analyze one of them. So one of the things, of course, is called cash flow. And cash flow means that after you've paid your monthly expenses, you actually have a positive income. Now, the issue with cash flow is that whether or not you're going to have it oftentimes depends on whether or not you're going to have a loan and how much that loan is going to be. And when we get into analyzing a specific property, I'll show you that by changing the loan amount, the loan to value ratio, lowering it or raising it obviously affects the cash flow. And in many areas, like in the area I'm in Silicon Valley right now, it is difficult to purchase rental properties because prices are so high and rent them out for the amount of the mortgage payment plus your other expenses. It's very difficult to do. The return on investment is one of the other ways of doing this. And again, when we get into one of the examples, I'll show you the software that does all this. But if you take your cash flow, right, what are you getting every month, and you add your principal payment times 12, you're going to end up with your investment costs, right, divided by your investment costs. So the principal payments, we're adding that in because eventually we're going to get that back out when we sell it, and lowering the indebtedness, which increases the equity, and you would divide your annual return by the total investment costs. Again, I'm going to show you an example. One of the things that you're going to see a lot when we look at some specific properties is reference to net operating income. Sometimes you're going to see references to effective gross income, as well as the net income. And so when we're looking at the net income, what we're going to do is we're going to take the current gross income, we're going to subtract a factor for vacancies and uncollected rents. We're going to subtract, vacancies, uncollected rents. We're going to subtract fixed expenses. Fixed expenses are things like property taxes and insurance premiums. They're fixed and they don't vary because of the number of occupants. In other words, if I have a 14-unit apartment building and it's half empty, the tax assessor isn't going to cut me any slack. The insurance company will be actually angry at me if there's that many vacancies, because there's a greater chance of arson in unoccupied units. So after I've taken the gross potential income and subtracted vacancies and uncollected rents, I end up with effective gross income, which is the money essentially I anticipate that I will get. I subtract fixed expenses, and fixed expenses are typically property taxes and insurance, with property taxes typically being the biggest expense. We subtract variable expenses, and variable expenses are the expenses that vary depending upon occupancy, like utilities and maintenance and things like that. And then the third thing we would deduct are reserves for the replacement of certain things. Now, when we get into the software, I'm going to show you a way of doing that. But one of the, and you could either calculate it out or use a factor, but we know at some point we may need to replace the roof, right? We may need to do some work on the foundation. We may need to repair or replace the air conditioning system. We may need, you get the idea. And so those are reserves that in our calculation, we want to be putting aside, so that when those things come due and we have to put on a new roof, we've already collected the reserves for the replacement of those items. So whereas the fixed expenses and variable expenses are actual dollars that we can see that have been paid out because there's checks written for those things, the reserves for replacements are not dollars that have actually been paid out, but are simply dollars that have been set aside. And this is one of the things that many people, when they're buying rental properties, don't consider, that they may have foundation repairs, they may have other renovations coming up, and is their calculation for net operating income taking into consideration that some of those things are going to have to be replaced. Now, what we don't do with the net operating income is at this point, we're not including any mortgage payments, right? Notice it says here, it does not include principal and interest payment, capital expenditures, depreciation, or amortization, right? Because this is the depreciation deduction in a investment property is more in the rate than it is in the income. That would take me a little while to explain, but I'm happy to do it later if you want. So essentially why we're not including those personal expenses and principal and interest is because that can vary depending upon the owner is. A simple way to say it is that the value of an investment property is not determined by the current owner's financing or the current owner's personal expenses. So when we're doing the net operating income of a property, we're only looking at the necessary operating expenses for that property. Now, those other things like, well, I'm going to have a loan and I'm going to have these other expenses and I'm going to have to travel, well, we can factor that in, but that's not what we would include in net operating income. How do you determine vacancy rate? Is there a standard? Well, that's a good question, Danny. Vacancy rates, a lot of times we just say there's a 5 to 10% is what people would historically and normally put in as a vacancy factor. Right now, that varies a lot depending upon your zip code and the kind of property. So for example, if you're in an area where the demand for rental units far exceeds the supply and the rental units do not stay on the market for very long, then perhaps using a lower vacancy factor But oftentimes we just do 5% or 6% or something like that, right? Just because they're all rented now, it doesn't mean that everybody's going to pay their rent, right? Doesn't mean that so you may have vacancies and uncollected rent 5 to 10%, but that can vary depending on the zip code. The other thing to keep in mind about the net operating income is, although we're basing it on what the trailing 12 months, the TTM, we'll look at that. Although we're basing it on the last 12 months of income, the money we're really using for net operating income is the future income of the building. So even though right now there may not be very many vacancies and the vacancy factor could be low, that doesn't necessarily mean that in 5 or 10 years we can expect that to be the same. So we would put in a calculation for vacancies. All right, so net operating income is the annual gross at 100% occupancy, the dollars we could get. We subtract vacancies and uncollected rents, the dollars we won't get. We end up with the dollars we will get, which is called effective gross income. You're going to see EGI coming up in some of the spreadsheets. That's what that refers to. We subtract expenses and now we have the net operating income. So what do we have? What do we do now, right? We've got the net operating income, and that brings us to another concept, which is called the capitalization rate. This is a concept that, I don't know, a lot of people, I'm not sure, really understand. Let me ask you this. What would be you're a buyer, you're an investor. There are two properties that you could buy. One has a 5% cap rate, the other one has a 7% cap rate. Which one is the better deal, 5% or 7? Now, with the calculator, I can do some calculations, and the general, I see a hand going up. And some people are texting it in. Which would be better, 5 or? Depends on the going rate in the area. You have two properties that you could buy. Two properties. One of them has a 5% cap rate. The other one has a 7% cap rate. Which one is the better deal if you're an investor? One person has suggested 7. Another one is going with 7. Hey, 7, right? It's a bigger number. It's a higher rate of return. Well, possibly, right? But not always the case. Fidel, did you want to ask a question, or are you just raising your hand? Did you want to ask a question? Text me if you do, because sometimes not everybody that raises their hand wants to ask a question. I'm just going to keep going. 7%. Text me if you want to ask a question. I'm not entirely sure that people, depends on the potential future cap X not factored into the NOI. All right, well, I don't know about that. All right. Let's say we have two buildings. And by the way, one of the things that complicates this discussion is because single-family residential, multifamily residential, commercial multifamily residential, which is 5 or more, and other commercial property types, the cap rates and things like that change dramatically. But let me just give you an example. Let's say there are two commercial buildings. They were both built at the same time. They're built by the same builder. They're right next to each other. They're the same square footage and design, essentially pretty much the same layout. Both buildings have just signed 10-year leases. The same leasing company wrote the leases, the whereases and the who, all that stuff, all the legal, everything is exactly the same. The rent is the same, right? The only difference functionally between these two properties is who the tenant is. Now, one of the buildings has been leased to Amazon for 10 years. And the other building has been leased to an independent hardware store. Which building would you rather own? The one leased to Amazon or the one to the independent hardware store? Most people would say, I want to go with the one with Amazon. Now, even if the independent hardware store has never missed a rent payment, always on time, it still may be a little more iffy, right? I hear Lowe's is going to be opening a store in that area. Walmart has announced that they're putting in a superstore. So the problem could be that the hardware person is on the ropes. So what that would mean, if both of these properties were $2 million investments, you would go with the one with the Amazon lease because it's considered to be safer. When we're doing capitalization, what we're really capitalizing is the value of the lease, not so much the value of the property. Because the value of the property in that sense is determined by the lease, right? Where does the income come from? It comes from the leases. So what would happen is the guy that owns the building with the independent hardware store would have to lower their price. In other words, if instead of $2 million, you could buy the hardware store building for $1,750,000, $250,000 less than the one rented to Amazon, you might take that risk. And what that effectively would do is it would increase your cap rate and it would increase your rate of return. Because it has a higher risk, it would have a higher rate. So if you're saying high cap rates are always good, no, not necessarily, because the higher the cap rate, usually the higher the risk is to the investment. One of the reasons in California that multifamily residential properties often have a very low cap rate is because they're considered by investors to be a low risk investment. And yes, there's rent control and you have to just cause eviction and there were COVID issues, but rents are going back up, right? Rents are going back up. The affordability percentage in California is not very good. And most people believe if you have fourplexes, triplexes, duplexes, 14 plexes and things like that, you're going to be able to rent them out and make money. It's safe, right? So the cap rates on multifamily are oftentimes very low compared to, let's say, a commercial retail rate, because it's also a function of risk. In California, appreciation is the true measure of value. It can be, it should be, but a lot of times when you have high appreciation, you have very low cash flow. And that's because when the prices are going up, because there's a high appreciation, it's difficult for you to be able to rent the property out for the amount of the mortgage payment. So what is a cap rate? Let's just, I put in a little example here. If you had a property that was $1 million and it had a net operating income of $100,000, then it's got a 10% rate, right? Now, again, the cap rate isn't talking about financing. It's assuming the property is unencumbered, right? Later, when we get to the software, I'll show you how to analyze what effect having a loan does. But let me just give you an example. Let's just make sure we understand that. So if we have the formula for determining cap rates is the income divided by the capitalization rate equals the value. Income, and that's the net operating income, divided by the capitalization rate equals the value. Getting a lot of questions on this. I say this in terms of other things, walk at the low cap rate of the lower rate. I see, yes. The fact that goes back, you're right, Nina, that goes back to the idea, excuse me, that goes back to the idea that multifamily residential in California is considered to be a safe investment because it generally appreciates. And there's more renters than there are homeowners. And as the value of single family condos and townhomes goes up, it creates more demand. All right, so let me just give you, let's just do a little bit of capitalization, right? just for fun, right? So if we have a net income of $100,000, income divided by rate equals value. So let's say an investor wants a 5% capitalization rate. That property is worth $2 million, right? If $100,000 is the net operating income and the capitalization rate is 7%, it's 1.42, well, 1.43, let's just round it up, 1,430,000. If we have $100,000 in taxable income and we divide it by a cap rate of 10%, it's worth $1 million. So what that means, so what makes an effective cap rate? It kind of depends on what's going on in your area for similar properties. So if you have an investor who says, I want to have a 7% cap rate, they're going to have difficulty, that's putting it mildly, of buying 1 or 2, 3, or 4 unit residential property or even small apartment buildings in California. They're going to have difficulty. I'm not saying it's not impossible. We're going to see some. I'm just saying there's difficulty. The other reasons that sometimes the cap rate is higher than other properties is because the property is an older property and they realize that it's going to need a lot of renovation in the future. There's a reason why one multifamily is 7% and another one is only 5%. There's a reason usually, and it's usually a reason that your investor should take into consideration rather than just saying, well, it's got a higher cap rate. Yeah, but this is an older property that's going to need a lot of renovation, right? It's you know, you need to be able to do to figure that in. Usually the rents or the expenses, I'm not sure. Anyhow, so I could spend a lot more time on capitalization. One of the things that I help agents that I coach and that are on my team with is doing stuff like this, because I can usually do the calculations with a calculator rather than using the software, even some that are more difficult. Now, this was from 2018. I'm going to show you a way of kind of determining that in your area. And back in 2018, this is the national average, had multifamily at 4 to 5.2. Some of them infill, by the way, is when they filled in vacant lots. But anyhow, major multifamily markets in California, 2.7 in San Francisco, 2.7 in San Jose, 3.0 in Orange County. And again, the reason our cap rates are kind of low is because of that. Now, one of the things that I included, just because I know you're a curious group, is this is a easy little calculator for capitalization rates. That one wasn't the important one that I wanted. Where's my handout? Oh, let me go back here. And the second link, which is really designed by this is an apartment property, and if you've got 5 or more units, it's considered an apartment. You can see there's some other tools and things like that, but one of the things you can do is put in an address of a property, put in the zip code of the property, and it'll give you a rough idea, let's just say, of what capitalization rates might be like. Again, we can get some of that information from our research on the multiple listing service, which I'm going to show you soon. Cash on cash return, when we're doing a actual scenario, it will calculate that automatically. And what cash on cash return says that it isn't just let's say I have $500,000 and properties cost $500,000. I could, and they appreciated at 10%, right? Let's just say that they're appreciating at 10%. So if I bought one property and I paid $500,000 cash for it and it went up 10%, that's $50,000. I've made 10%. That would make sense. But let's say instead I took my $500,000 and I bought 5 properties, putting $100,000 down and borrowing $400,000. And let's just say the interest rate is 4%. Right now, if they all go up 10%, and it's true, I've got an interest rate to factor in, but if they all go up 10%, then I have made $250,000. 10% on 500,000 times 5. I've made $250,000, which is a 50% return. So by leveraging and using other people's money, and I'm looking at how much of my cash do I put in versus how much cash do I get out, and what is that return, that's a different number. Maybe I should just keep the, thank you for the handout. These, oh, you're welcome. Somebody I thought was going to complain, but not yet. How is loan qualification determined? I'll talk a little bit about that, but not very much. Those are some of the basic ones. But Danny was asking, how are the loans calculated? It's a little complicated. I'll show you some samples. But you may hear, these are some bonus ways of valuing property. You might hear about the 2% rule. One of the challenges of watching stuff on YouTube and reading, Bigger Pockets and some of the national things about, investing is that it doesn't always work in California. And even in California, if you're in Silicon Valley, which is one of the more intense areas, there's some areas in LA that are like that too. There's areas in Berkeley and things like that that are like this too, where it's a really intense area, then those general things don't really work. So the 2% rule, which I hear people still talking about, is that the monthly income has to be 2% of whatever the price of the property was. So if you had a $300,000 property, you would need to be renting it out at $6,000 a month. You can't do that in California. I don't know where you can do that, right? And although you might hear people, you might even have clients that say, I hear that there's a 2% rule, right? That doesn't work, not in California. 1% rule, which I have clients of 2019. I had some buyers, Chinese investors, all cash. They were willing to buy multifamily, Santa Clara County, up to 20 units, and price was not an issue, right? They had no ceiling on how much they were willing to spend. However, it had to meet the 1% rule, and the 1% rule says that instead of 2%, right, we're going to cut that in half. So if we were buying a property for $300,000, we would only need to rent it for $3,000 a month, half of the 2% rule. Now, that theoretically wouldn't have been a hard thing for me to find if anyone was selling multifamily residential dwellings. I mean, I had cash buyers ready to go. The problem was nobody was selling their multi-units at that time, right? They just aren't, because in California, the multi-units are like a cash cow. They just keep pumping out money. You also may hear about a gross income multiplier, and the gross income multiplier is a rule of thumb that in different areas, people are getting a certain multiple of whatever the gross is. In 2018, I sold a duplex in Cupertino, and at the time, the Cupertino multiplier, that area, looked to be about 20. Yeah, the mortgage, I'll get back to that next. Many of these rules, by the way, the question was the 2% rule back when interest rates are higher and properties are dropping in value, then some of these things work a little bit better. Right. But let me go back to so in Cupertino, the multiplier was about 20. How do I know that? Well, first of all, there are places that you can search, and I was looking at other duplexes, triplexes that had sold, looking at their gross income and the sales price. So the property that I sold, I represented the buyer, had $100,000 of gross income. Using a 20 multiplier, that would be $2 million. and we actually closed at 2,017. We talked about 2,017,000. I forget why we ended up with 17. I think we built anyhow. So gross income times the gross income multiplier for that area equals the value. Right now, this is just a general assumption. As I point out here, that old properties with deferred maintenance should have a lower gross rent multiplier. And those that were built recently could have a much higher one, right? And if you're wondering what the gross multiplier might be, depending upon your city, I included a link. You have to be careful with some of these sites. And where I'm going to show you, you can look in the MLS and see what kind of gross rent multipliers people are getting. Because one of the other sites that purports to tell people what gross rent multipliers are in different areas, it thinks, I'll use San Jose as an example. Here, I'm going to go over here and type in San Jose. All right. So you can see that San Jose, according to this analysis, has a 14.71, let's say 15 gross rent multiplier. I believe that, right? That to me sounds accurate. Cupertino was higher because it was Cupertino, and it was, which has very good school districts, and among the school districts, the schools, this one was even in the better schools of Cupertino. It had a multiplier of 20. When San Francisco was before the pandemic, their multiplier was like 30. But I've seen somebody recently say that the multiplier for San Jose was over 40. How did they come up with that number? And the answer is they took the median price of a house in San Jose and they took the median rental and they divided. And so they came up with 40. Now, the problem with that system is that it assumes that a median house in San Jose is a typical rental, and that is not the case, right? The median house in San Jose is not the median value of a rental in San Jose. It's just not. But you're going to see that that's going to vary depending upon where you are. It's going to vary, right? It's going to vary. But again, you could look in the MLS. So ARV and BRV, somebody asked me to explain those. There's also, you're going to hear if you have investor clients and they're online and studying the 70% rule. And what the 70, what ARV means, after repaired value. And this is sometimes one of the more difficult things. Not sometimes it's not, but most experienced flippers want conformity. They want to buy a property where there are very similar properties in the neighborhood that have sold recently. Typical investors will only go out a quarter of a mile from where the subject property is. Not a half a mile, not 3/4, not a mile, because it's location, location, and location. And they would rather have an older, close comparable, because you could adjust it upwards or downwards to, because of the market, rather than something that was further away. And you don't want properties that are unique, because then we don't really know what it's going to be. But ARV means if we fixed it up. And so typically what we're doing is we're looking at the properties in that area that have sold recently that are all fixed up, that have the new floors and the new kitchens and new bathrooms and things like that. And then we determine what they're getting price per square foot, right? And that number would be the ARV, the as repaired value. BRV, before repaired value, is essentially what are they selling it for now. So the 70% rule says is that we're going to take the after repaired value, and sometimes they subtract the cost and then multiply it by 70%. Sometimes they multiply 70% and then subtract the cost. But you can just, you can get an idea from that. The two things here that you really need to know is what really is this property likely to be worth once we fixed it up. You can't be too far off. And secondly, you need to know what is the estimated repair cost. And the idea of the 70-30 is that the 30% represents profits and a little bit of a buffer. If you want to play with that, right? Here's a calculator. So let's say we had a property that was worth, I'm going with my hood, $1 million, and we had $150,000 of repairs, then using the 70%, we can only offer $550,000. Now, some of you might be seeing, well, the problem with this. And the problem is, how am I going to get somebody who has a house that could be worth $1 million to sell it for $550,000? That's a very good question, right? Which is why, in my experience, the 70% rule does not work in the markets that we're in. It might work in, I don't know, North Dakota or someplace like that. I don't know, but I don't see it working very much in my markets because it's hard to get people to sell it for that. Right? It's hard, right? But you understand if you needed to get 30%, and if you changed it to 75, right? Because you're not going to be as conservative, then 600,000 is all you can do, right? Because if you've got 150,000 in renovations and it's going to be worth $1 million and you want a 25% profit, 600,000. Now, for those of you that are wondering, what's this wholesaler calculation thing? Wholesalers are bird dogs, right? Wholesalers are people that scout around looking for trashed homes. They go knock on the door and they say, hi, I am an investor who's interested in buying properties in this neighborhood. Are you interested in selling your property for cash? And they say, yeah, I might be interested in doing that. And so what the wholesaler does is they get the property under contract and then they assign or sell the contract to an investor. How much does the wholesaler want to make? Well, that would be something if the wholesaler says, I want 50 grand or I ain't doing it. Now, in order to pay the wholesaler anything, we're down to 550. Right now, again, I'm not saying this is the 70% works in my area. Notice, and that particular calculator doesn't allow me to go up any higher, but you could, this is not a difficult calculation. In our areas, it might be closer to 85%. You need to be accurate if you're the investor on what the value is going to be when it's done and what it's going to cost. Then there's the 50% rule. Right? So what this is saying, and again, I don't see this working in my area, but what this is saying is that you ought to calculate that 50% of the gross rent is going to go to expenses and renovations and everything else, 50%. So if you're not, so what would that look like, right? So in other words, you would take the rent, let's say it's $5,000 a month, you would be, for purposes of profit, cash flow would be considering $2,500 a month, because you're basically saying that half of the money is going to go to all the expenses and everything else, right? Even mortgage, and by the way, they're not even including loan. I hear people talking about the 50% rule, but it doesn't work in our market. What you're going to have to do is evaluation, which I'm going to do in a minute. The 10% rule is a modification of the gross rent multiplier, where people are saying, well, I want the gross income to be at least 10% of the purchase price. If I'm paying $500,000, I want the gross income to be $50,000, right? Now, what would be better is that if we actually analyzed this, and there's software to do it. I have some links to it, and why don't we actually do it? Why don't we actually do it? So what I'm going to do, and I'm going to use a multifamily as an example. I'm not going to take people's suggestions because usually when I'm doing that, people give me weird properties, right? Weird properties. And let's say I'm looking for a fourplex, and I've got a $2 million budget, 394, right? And that's in everything. Let's say Santa Clara County. How many are there in Santa Clara? Oh, that's not the right one. All right. 11. Notice how it went down from over 300 to 11. You can just get the idea. Prices are a little bit higher in Santa Clara County. So, but I'm using this one because, you know, I know it. So this is what we get. These are the 11 fourplexes that are for sale for under $2 million. Look at the days on market on some of these guys. 185, 93, 68. The market is sometimes a little slower. Let's pick out, how about this one? Just for, I don't know, just for giggles. Now, I may need to keep going. All right. All right, now this one, so let's just take a look at this. All right. So let's say I have an investor interested in this. What I'm going to be looking at as I scroll down, and there, you know, there's pictures and things like that. They have disclosures, you know, Santa Clara County, they usually do. What this is showing me is that it says it's vacant. So I'm not really too sure, because what it's showing is rent for 4 units, but it's not giving me bedrooms and bathrooms, right? It's just not. Now, what is unclear, because it said vacant up here, what is, oh, unit 4 is vacant and easy to show. All right. So typically you can't show fourplexes like you would unless one of them is vacant or the owner lives in one. So one of them is vacant, 3 of them are rented. So, but they put in numbers, right? I don't know why, but if it's vacant, there shouldn't be a number there, but they're telling you, they're not giving you bedrooms and bathrooms. They're not, but they're giving you an example of what the rent might be. Right now, I'm not sure. They didn't welcome to my world. They don't answer all the questions about the property. Can you reduce Michael's picture and enlarge the screen? He's discussing. Doing my picture is taking up too much. Really? I wasn't aware. Excuse me. So the other thing that I'm going to look at, right, because we don't really know what the rent is on these, what the terms of the leases are. We really don't know. They've done something down here in that they've given us what their annual, this is supposed to be operating income, right? That's the income gross scheduled. They're not giving us all the numbers. They're saying that the gross income is the same as the net income. And this, by the way, is relatively common, that we don't have everything, right? We just don't. And the reason is because the agent doesn't put in all the information, right? The agent just doesn't do it. Right. Sometimes agents don't do it because they don't know how, they don't know what they're doing. There is some rent information, yes, but one of them is vacant. Notice I know one of them is vacant since it says so, but there's no vacancies listed here. Notice they haven't itemized any of the expenses. They say landscaping is $100, unless this is a triple net, which very few residential properties are. They haven't told us all the expenses. They just haven't, right? This is not uncommon, right? Now, notice over here, they've given us an estimated gross rent multiplier of 20, which, what city are we in? Mountain View. Well, that might be right. and a cap rate of 4.85, which by itself doesn't necessarily look bad on a multi-unit. Let's see what else we've got. All right, just to take a look at these, here's another beauty. Do not disturb tenants. Here they're telling us a little bit better. Notice how this one, they've given us expenses, landscaping, maintenance, right? The taxes, that of course is going to change. One of the things that I look at is rent only, trash removal, utilities, electric utilities, and gas. So the operating expenses include property tax, insurance, maintenance services, gardeners, utilities, water, and things like that. That gives us estimates for those. And so we could see that their effective gross, their annual gross is 122. That's also the effect of their net income would be 92,000 after you subtracted the expenses. That means a multiplier of 13.8. I believe that. That's more believable because 14 was in the San Jose metropolitan, Sunnyvale metropolitan area with a cap rate of 5.4%. All right. And this one, why not? All right. So let's say we're going to look at this one, right? Just as an example. Why not? So I usually copy this because sometimes everything doesn't work the way I want it to. And I'm going to go here and I'm going to find the little button. See those little buttons? I'm going to click on it. And I don't know why I did that. This has nothing to do with EXP. This has to do with, that's really odd. But I'm not going to analyze what's going on with RPR. Notice I copied the address first. Sometimes the MLS buttons don't always work. Oh. So here it is. And we could spend time analyzing this, but which we're going to do, but by spend time analyzing it, I mean you could go back and look at when people bought it and all that other kind of stuff and try to get an idea of how much it's appreciated. But where we're going to go now is to evaluate, right? Evaluate. Now, when you click on this, it's going to ask, do you want to view some of this training? Which is probably not a bad idea if you don't know how to do this. And I'm going to click on continue. And there we go. All right. So I'm going to that one. How about that? Without paying extra, you can only have like 5. All right, so let me go. I really wanted to, let's try this again. I thought I had already done it. Let me. One more time. We'll see if this is happier. No, and I'm just surprised that RPR is not loading. What I found with RPR is that I prefer to fill out a lot of the things at the beginning of it. Let's just see if it's, I should have, all right. Why didn't it? I'm going to select all. All right, there we go. So I got rid of all my, you can only, for free, you can store 5 of these reports at any one time. All right, so assuming you haven't, like me, maxed out, this is what you're going to see. Now, because I'm doing this right from the MLS, they know, they being RPR, that this is a multifamily property. Now, if I click on that, you can see there are a lot of different options. For example, if I were analyzing a single family residence, I would check that, or a condominium, and then that's going to give me actually different options. But if it's purely multifamily, now I could actually just leave this analysis for, let's say I planned on making multiple spreadsheets, multiple evaluations. Why might I need to do multiple ones? Well, the most common reason is because the property might need renovations. So I might do an analysis without renovations, and then I might do an analysis with renovations. Right. Now, what I need to add all this up. Where are we? Back here. So what is the rental? It's 122,028, right? Is the gross rental. They don't have any vacancy factor. Income, scheduled gross. So let me go back here. So what is it? TTM is trailing 12 months of potential rent. And TTM is trailing 12 months of expenses. So what I get, because they've actually helped us out, I'm going to do, I'm going to just copy this, right, and say that's my income, and based upon the last 12 months, right, and I'm going to enter it, and then expenses, I'm going to go back here, and what are the total expenses? Total 29,000. I'm going to copy that, and then I'm going to put that in here. Now, sometimes what I'll do is take that number, right, and I'm going to divide by 11 and hit enter. And for some reason, that's not what I wanted. So what am I trying to do? How about this? Let me go back. If somebody can figure out why I want to do it by 11, you'll get a cookie. Do you need to adjust for the new tax amount? Yeah, we're going to get to that. So 122,568 is 12 months. So I'm going to divide by 12. Monthly is 10,214, multiply by 11 months, 112,354. Now, one reason I might do that is because at some point in this process, I'm going to have to come up with vacancies, uncollected rents, and things like that, right? At some point in this process. So rather than deducting that later with the vacancy factor, sometimes I just take it and multiply it by 11 months. Now, to deduct 1 month as a vacancy is about 8%, which could be a little bit high. But either we're going to need to put that in vacancies later, or here we could just make it 11 months, 11 and a half months, right? That could vary. What is the annual percentage growth rate in terms of rents and things like that? I usually leave it for that. If we were going to be buying right away, and let's say November 1st or December 1st would be the, when we think we're going to close, which would be the beginning of our fiscal year. Holding period is something you have to talk to them about, right? Have to talk to them about. How long are they planning on hold? Now, multifamily residential tends to be held longer than like commercial retail. Many commercial retail buyers are looking for 5 years. Most of the multifamily ones are going to hang on to it for longer, but that's a discussion you would have to have with your client. 10 years is the longest you can do. Loan to value ratio. If this is a non-owner occupied loan, then you're going to find that you don't get the same interest rate, the same terms, same loan to value ratio typically that you get on owner occupied. You don't. So 65%, is a default here. 70% is actually a typical one, but you're going to see that making changes to that will affect our cash flow. And again, it depends on the property. So once you've crossed 4 units, when you get to 5 or more, most of the lenders that you're familiar with have dropped out of the race. Golden One Credit Union, Bank of America, Wells Fargo, Chase, they're not usually once you've gone to 5 or more. So the loans change, the lenders change, and the interest rate goes up. A loan to buy a 4-plex is very different from a loan to buy a 5-plex, right? But let's just say 4%. We're only going to assume there's one equity partner. This process has you can do multiple investors. I didn't do it, but I had a transaction where there was 20 some investors. It was an investment pool buying land, right? But we're not going to go there. We're going to hit, no, by the way, it's better to have these numbers ready when you are at this screen, right? But we can change it later. We're going to hit submit. Okay, now these are the different things, the different tabs here, things. Let's just look at the things. Levered versus unlevered, right? This is not a type of bread or baking. Not that, I'm not even sure. So leverage means using other people's money, which means a loan. An unlevered analysis means there is no loan. So if we were to buy this property without a loan, our net cash flow is, well, a lot, right? By the time we're done, our internal rate of return is relatively high. But if you look over here, our average cash on cash return is 8.5%. Right now, and by the way, we haven't put in all of the numbers we need to put in yet, but this will change as we go through. Levered means a loan, which and this is calculating it, by the way, for all 10 years, right? And what it's showing is that our rate of return goes up. IRR stands for internal rate of return. What's the difference between a cap rate and an internal rate of return? I can hear you asking, right? A cap rate is two big things that aren't included in a capitalization calculation. Number one is appreciation of the property. Capitalization doesn't take that into consideration, that the property might be going up in value every year. Number two, it doesn't take into consideration the fact that you're making a loan payment. Right, so because in cap rates, we're doing a very neutral, generic kind of an analysis. But given a particular investor, they want to know, well, what's the appreciation going to be like? And what am I going to be able to do with my loan payments? How is that going to affect it? By using other people's money, in this case, you're making a higher cash on cash than if you had paid all cash for it. All right, and then this is breaking it down. And what it's doing, notice how it shows the cap rates going up, right? So why does the cap rate go up every year? And the answer is there's sort of a prediction that over time your property is going to need renovations, it's going to need more work, and that all of that is going to, if you don't do it, is going to affect your cap rate. So over time, the cap rate is going to need to get higher because of renovations and things like that. This little thing down here is fine. We didn't put in parking spaces, occupancy, right? Is it, how occupied is it? Let's say it's 100%. Occupied, right? That doesn't really change anything. Price per square foot, first year cap rate, right? It calculates all that for us. Holding period, sale, year, net operating income. This is assuming the appreciation, the sale cap rate. Now, we haven't actually calculated, notice sale valuation. One of the things we haven't calculated is whether or not the value is going to go up, right? It's not by how much. It's got a property growth value of 5.20. That's something we might, be able to change later. Unlevered returns, more stuff. All right, now the levered analysis, I don't oftentimes spend as much time on this, but you can see there's something, an issue here, which I may need to spend more time to figure out. Rent rolls is a tab you only get. A rent roll is something you only get on multifamily residential, where notice the default is a studio. You can go in, enter the unit numbers, explain, is it a 2-1, is it renovated or unrenovated, right? And the reason that you would want to note that is because if it's unrenovated, it may need to be renovated, and we may need to estimate and predict when that's going to be. Due to a higher on leverage, does this mean it's better to finance instead of paying the loan off? Sometimes it is. You oftentimes can get a higher rate of return, a cash on cash return, by borrowing the money, because you get 100% of the appreciation. And if the appreciation rate is greater than the interest rate, using other people's money increases the cash in to the cash out return. Cash flow gives you examples. Purchase and sale. Okay, now one of the things that we may not have done, notice here it says closing costs. You see that over here? Closing costs. Renovation budget. Notice we haven't put that in yet. So one of the things we would want to know is, are we going to need to renovate it, right? Are we going to need to? That we would put those numbers in. Closing costs. Does the buyer have expenses when the buyer buys this property? The answer is yes. Those expenses can vary based upon the county. I happen to be in Santa Clara County, where the seller pays escrow and title customarily. Alameda County, the buyer typically pays, right? You understand you need, and by the way, the title companies, I use Chicago Title, they have an app that would estimate what those closing costs might be. Let's say we don't know, so we're going to put in 3%. Well, let me do that. Well, let me just type in percent. No, it's not going to let me do that. Let me just. I would have to multiply that out. What would be the 3%? Right? What would that be? It's not $3, but you know what I'm saying. So you would need to estimate what those closing costs are. Capital reserve means, are we wanting to put aside money to fix things when they become broken? So here, is there a transfer tax? Are there recording fees? Is there going to be, other taxes and things like that? Holding period, capitalization rate, price per square foot. What do I want to do here? Net proceeds. Yeah. Now, one way we can change a lot of these numbers is when we go to source of funds, because what this would allow us to do, notice we could change the loan to value ratio, right? We could change it. And debt service coverage, 1 year debt service coverage, 1.25. Should I explain what that means? Minimum debt service is over here. Ratio test 1.3. All right. If we're talking about 5 or more units, if you're getting a loan, they're not really lending you the money, even though your name is on the loan. They're loaning the property the money. Now, if it's 1 to 4 units, and it's a 1 to 4 unit residential, and you're going through Goldman 1, they're interested in you and your credit score and all of that sort of stuff. Once you get to 5 or more, the lender isn't so concerned about your credit score or your income or your debt. They really don't care so much. What they care about is, does the property produce enough money every month with a factor to cover the mortgage payment? That factor could be 1.2. This is over here, right? Could be 1.2, could be 1.25, could be 1.3, right? It varies by lender. So if your property is producing enough income on a monthly basis to cover the mortgage plus 30%, you're going to get a loan. Right? Even if you've got a bad credit score, you'll probably still get a loan. Because the lender is thinking, how could we go wrong if you don't make the payments? We'll just take over the property and it makes more money than the mortgage payments, right? So does the property qualify? And that's where this debt service ratio comes up. One of the things that we can do with this is we could share it. And by sharing it, it means we could share it as a hyperlink. They'll give us a link, right? And so it's giving me loan amount exceeds maximum loan on the loan to value ratio. So I'm going to have to let me go back to that. One of the nice things about the program, it'll remind you if you need to fix stuff. I almost always have to fix stuff, but you see that link that was created is a link. We'll see what this looks like, that I could share with a client. You said that's at 5 or more units. I said 5 or more units is the debt load factor, and all that stuff starts to come into play, right? At 5 or more units. And you notice you could add a property image, and there's a map, and there's a whole bunch of other things. If you spend a little bit of time on this, it'll make a really nice report, which when you're done, right, when you have the report, the file, you can export it, right? You could export it. You also could save it as a new, means that, let's say I wanted to redo this, only I wanted to put in renovation costs, but I didn't want to go through and retype everything. I could save it as a new and then go put in as a new property and put in renovation costs. But I also can export it as a PDF, let's just say. And what I might do with this is, right, that's what it looks like, right? Now, going back to our property, here we are, yeah. Now, some of the stuff that they give you for RPR, it's okay, but it's not, we use different things in commercial, but if I go to create a report, one of the things that it ought to know, has it figured it out yet? Let me go back here. It doesn't know. So if I created a report, this would give me, and I forgot that I'm not doing 5 or more. If I were doing 5 or more, and I go back to reports, what it's going to give me are different reports. And the reason it'll give me different reports is because once it hits 5, it's a commercial property, and I would now be an RPR commercial, right? But 1 to 4, still RPR residential. So I could create a seller report, right? And by the way, you might have market data, you might have, but, and then notice where it says manage custom pages, I can upload that PDF that I just exported from Valuate and attach it to the report. Now, if this were commercial property, right? Let's say this was commercial property, and I, let me see, my recent properties in commercial. I don't know. When have I done the recent one in commercial? I don't know. So I don't as often, but let me just say, and the RPR is connected to CREXI. Yeah, I know. And so what I'm going to do is just, how about pick one? How about this one? All right. Just to give you an example. So this is a commercial property. When I go to create report, notice it gives me different reports, right? Trade area, trade analysis, the property report. The property report is a commercial property report. When you get to 5 or more, and then again, I would connect those printouts with it, right? Now, there's actually even more that you can do, because if we go up, I'm not going to get into all of this, but one of the things that we can do is, if it were an office building, Valuate has a particular template for office buildings for other kinds of specialized properties. Right? And if you're part of my group or would like to be, I help agents with this. I think I'm eating up my time, but let me just say one. So flipping is a different conversation, and Valuate also has, if it's a single family home, and I'll do that really quickly because that won't take very long. I don't know why RPR is doing this. So let me go back to RPR. I'm going to go back to residential. I'll pick one. How about this one? Why not? Beautiful, beautiful. So let's say we were going to flip this puppy. We would go here, we would go to continue. It's still doing that. I thought I got rid of them all. I don't know why. So I'm going to do all this. And I'm going to submit, because I don't know why. It wants me to upgrade, obviously. Oh, I see what the issue is. 1, 1, 2, 3, 4, 5. Okay, maybe you'll be happy now. All right, there we go. All right, are you happy now? Cool. All right, so now let me go back and try it again. Oh, well. So what it's fussing with me right now, and I don't know why, but I'm just not going to fool with this anymore. I need to delete all of them in order to do another one, but it also gives us a similar template on fixing and flipping, right? Which maybe I'll do at another issue. But it's just, it wants me to get rid of them. I do it too much. All right, some final thoughts. The market for fixers and flippers is very different from the buy and hold, and the residential 1 to 4 buy and hold is different from 5 and more residential. It's different when you get to retail and commercial and things like that. I included a link. EXP has something called Express Offers, which is an iBuyer program, which would help you to find people that wanted to sell a fixer. The other thing, let me just say about commercial, I'll do this in a couple of minutes and then we'll be done. Most real estate companies will tell you that if you're a residential agent, you can't do commercial. Commercial is 5 or more, right? You can't do commercial. And then you have to refer it to a commercial agent. One of the companies that I worked at had a commercial division, and they told all the residential agents, if you have any commercial transactions, you have to refer it to the commercial division. So some of the residential agents asked, are the commercial agents are they required to refer residential transactions to the residential division? And they were told, no, of course not. They're capable of handling residential transactions, but you have to send all your commercial deals to them. Well, one of the new agents that I was mentoring, which means I have a contractual relationship to help the agent and for which I'm going to be compensated, her buyer, her seller, who had a listing of a residential property, also wanted to buy a commercial property. And so she was told she had to give that to the residential division for a referral fee. That's the only way she could do it. Well, the agent, the commercial agent, who's the director of the commercial division, told her, hey, you know, the residential part of this, I could help you do that. You don't need Mike to help you with, I could help you do that, and I'll charge less than he would charge, right? Now, this actually upset the agent because she thought that was sort of an unethical, sleazy kind of thing to do. And so she complained, right, to the owner of the company. And, you know, he was like, oh, well, that's not a good thing. Well, then it turns out that the commercial, and this is the director of the commercial division for this company, that commercial agent, when she had talked to the client, said to the client, you know, that residential property you have, I could handle that sale too, just to make everything work, you know, work fine. And basically she was throwing the new agent under the bus as well. We both complained, you know, and the commercial director for that company resigned because this kind of looks bad. And then what happened is I left that company. You can probably guess why. I left the company, and so did the other new agent, and we both went elsewhere. And so they hired back that same person to run the commercial division, and today that person is running that commercial division for that company. Now, the reason I'm saying this is my experience. I'm sure there are a lot of very honest and ethical and nice and all that commercial agents, but I'm just telling you, my experience has been they are on large a more cutthroat group than, and you might be saying more than residential. The answer is yes, more than residential. You need to be careful. Another agent that that now works with me, who had gone to Marcus and Millichap and had been assigned a commercial mentor. The commercial mentor only would let her make phone calls to get leads, wouldn't let her go on the appointments, wouldn't even let her see the proposals that were eventually made, wasn't allowed to learn anything that was happening in escrow because the mentor didn't want her to become self-sufficient. He only wanted somebody that would make calls, and all of the transactions went through the mentor's name. The agent got paid, but got no recognition for it. Welcome to the world of commercial real estate, right? There's oftentimes, they're not in the MLS, people are trying to double in them. Now, the reason I mentioned this is that if you're at EXP and you're on my team, EXP also has a commercial division. And if you're doing commercial real estate as a residential agent, you have to refer it to a commercial agent, or you have to be on a team or have a mentor who has been approved by the broker to do commercial transactions. I'm approved by the broker. I was the commercial mentor for Keller Williams Cupertino. That's not the branch I was referring to, but let's just say it's another office with the initials K and W, right, in the Silicon Valley area, just another one. So one of the things that I have people that are on my team primarily because they want to do more than 1 to 4 residential. They would like to do commercial. And so I can, if you're interested in doing more of this, learning more about it, let me know. Reach out to me. And if you would like more about this kind of stuff, let me know as well, because we didn't really get through the whole flip thing because, you know, I talked too long about other things. Any questions, anything I haven't covered that would be a burning desire for anyone? No? All right. I'm not saying great information. Thank you, everybody. Anyhow, stay safe out there. Let's see, and maybe we'll do some more later. Talk to you later, guys. Bye.